I'd like to now talk about the basics in investing, right? So if these are for the neophytes that know nothing about investing, you're really going to find this of great value. I'm going to simplify the investing world for you now. There are 7 basic assets when investing. What are those 7 assets? So they are banks, bonds, stocks, real estate, insurance, commodities, and currencies. Now, everything else is just packaging. Everything boils down to these 7 investments out there, right? So let's talk about some of these assets. First, we have banks. Banks, everyone knows, you drive around any major city, or even not even a major city, just any city or township, you'll see a bank. Banks are they're a very profitable business model. They don't have to produce or manufacture anything. They're essentially taking your money and they're employing that money by loaning to other institutions and or selling mortgages, essentially, making loans to help you acquire a property or whatever. So with that in mind, they don't have to produce anything. There's no overhead. Yes, it's a brick and mortar store, but generally speaking, just paying employees and keeping the lights on is their overhead. What happens is while you're getting paid a fraction of a percent, they're making 2 or 3% loaning to another institution. They work with the law of large numbers. Because they're dealing in bulk, they make a big profit. Banks they were great in the 80s and even the early 90s because you got a good rate of return. These days, you're not seeing very much in terms of your bank account. Right now, I'm shooting this in the beginning of 2019. So, even though interest rates are now creeping up, you're still seeing a very modest return with a bank account. When you put your money right now in a bank account, you're forsaking a return for safety. The ability to access your money in an ATM or savings account or checking account, just like that, you're giving up a good return, a gain for the price of liquidity. Right? So a bank account right now is not a great way to go in terms of making a serious profit. And when looking at bank accounts, you see the big challenge, which is essentially inflation, right? Bank accounts don't hedge against inflation right now because inflation, if you didn't know, inflation is basically the illusion of progress. It's the price of goods and services gets higher every year. So with that in mind, it's about 3 to 4% where your dollar isn't worth $1 at the end of the year. It's worth 97 cents. So with that, roughly 97 cents. So with that in mind, you need to be able to hedge against inflation. So banks are not the best way in terms of getting a serious gain or making a serious return with your investment. Next, we have bonds. Bonds are quite simply a loan. You're acting as the bank, and you're loaning to either a government or a corporation for them to come up with great things like the iPhone or build a bridge or build a casino. Depending on the company and what their industry is, they take that money and they employ that money for a variety of different purposes. The way bonds work, we'll not get too deep in the weeds, so to speak, right now, but bonds are long-term investments. They usually are more secure, meaning they don't yield as much, but they still guarantee a little bit more safety than you would with a stock, for example. It's basically somewhere in between a stock and a bank account, where you get more return when you take on a little less safety than a bank, but more safety than you would a stock. So next we have stocks. Stocks are by nature volatile. Now there are 2 different types of stock. There's preferred stock and there's common stock. Common stock is when you, for example, Chipotle, we'll use that as an example. Chipotle, you get it at 400, you hope it goes to 500. When you cash out, you make the money. Otherwise, it's a paper loss or a paper gain. That's common stock. With preferred stock, Yes, that applies, but you also have something called dividends. Dividends are paid on a quarterly basis, right? So because you're one of thousands of owners in this company, they're going to pay you back, because you're a shareholder, a certain amount of money by being a shareholder consistently on a quarterly basis versus bonds, which pay on a semi-annually basis. So for that reason, you get consistency in income as well as the share price. And that's why preferred stock, we like them better as a firm, because you get that consistency in income. However, well, we like them better because you get that consistency in income. Next, we have real estate. Real estate is we like it in a portfolio. It's the only asset that needs to be fed. You have to evict tenants, you have to mow the lawn, you have landscaping, you have to repair the leaky roof, repair plumbing issues. So again, you're feeding a lot of the money into that real estate. I know a lot of people like real estate because you can kick it, touch it, smell it, feel it, but you also have a higher risk factor when you're in certain areas, like a flooding area, a high fire area. You have damage that can be done by tenants. So again, this is the one investment that must be fed to keep it consistently generating income, which ultimately affects your bottom dollar. Next, we have insurance. Now, most people equate insurance to things like health insurance or car insurance, but what they don't know is there's certain assets out there, investments through an insurance medium, where you can still make a profit and not have to die like life insurance. You can still make money. Now, let's talk about life insurance for a minute. Life insurance is basically just death insurance. Basically, you're hedging, hoping that if something were to happen to you, you're going to be able to provide for your family, regardless if you pass on. So really, it's death insurance, but don't call it death insurance because it doesn't sound sexy. So they call it life insurance because it sounds happier, and that's just marketing. So besides that, you have also something called annuities, where annuities get you consistency in income, so you don't outlive your income when you're a retiree, right? Now, there are both, for lack of a better word, good and bad annuities, and we can discuss that in another module. But for this purpose, just understand that there are investment vehicles you can go through insurance media, where like you're investing you're insuring your car, you're insuring your health, you can insure your portfolio as well. And again, we'll talk about in a different module. Next, we have commodities. Commodities are where you're investing in things like pork bellies, soybeans, orange juice, oil. You're investing in precious metals like gold. These are things that usually have high volatility. We generally, as a firm, don't tend to gravitate towards these because they carry higher risk. But understand they are around and they exist. And if you're a risk taker, I think, that you can explore those in some cases. But there usually is higher volatility with those. And again, that's depending on a variety of different factors. And again, that can be left in another module down the line. Finally, we have currencies. Currencies is if you're trading money, pound against the dollar. Again, just you're going back and forth swapping, the euro for a dollar or whatever, and hoping that something happens, and you're going in at a certain point where you're buying low and selling high in a very, very basic principle. So I hope this is helpful in terms of a basics 101 investing. This is a great way to kind of put things in perspective. 7 investments. I hope this was helpful. If you have questions, feel free to drop me a line at the office. I look forward to helping you. Have a great day.